of the financial meltdown, the Obama administration had big plans for reforming the system.
But this morning, a somewhat less ambitious plan is on the table. And joining us now to talk about the bill, Senator Chris Dodd. He's the chairman of the Senate Banking Committee. Senator, it's great to see you this morning.
Good to see you, John.
One report I read this morning said if Wall Street doesn't like it, it can't be all bad. But many consumer groups are saying that this doesn't go far enough. And not one Republican has signed on to it at this point. So, Senator, what do you really have here?
Well, we think we have a very good, probably the most comprehensive reform of the financial services sector since 1930s. And a lot of work has gone into this, John, and we have a lot of bipartisan support for major provisions of this bill. In fact, a lot of them were written by my colleagues on the committee. For instance, the whole area of too big to fail, which is a major provision to this bill. A lot of that was done entirely by Senator Mark Warner of Virginia, the Democrat, and Bob Corker, the Republican of Tennessee. That's one major section where we have, I think, almost unanimous agreement about that section of the bill. A lot of other work has gone into the other 10 titles of this bill. Richard Shelby, my Republican colleague, said yesterday that he thought we were about 85% there on this bill. A lot of work has gone into this, John, over many, many months. I can't even begin to tell you the thousands of hours that have been spent working on this product that I presented yesterday. So I'm much more optimistic that we can get this job done. We have to do it. We can never go back to where we were before and put the wreckage economically in this country. We all talk about Bear Stearns and we talk about Lehman Brothers and AIG. But think of those businesses, those jobs, 8.4 million jobs, 7 million homes, retirement income,
right.
Trillions of dollars lost. This bill is designed to plug those gaps so we never, ever again are in that kind of a crisis with those kind of effects.
And so for the American people that are watching today and saying, you know, I got hammered because of this.
Right.
I got hammered because I feel that Wall Street got bailed out, that Congress perhaps looked the other way, and in the meantime, I either lost my life savings or currently my job. How does this bill help them?
Well, one, we're never going to see too big to fail again. That is the idea that some institution would get so interconnected, so complex, so large, that they would have that implicit guarantee that the American taxpayer would write a $700 billion check to bail them out. That's over with. That'll never happen again. The presumption is bankruptcy. You start collapsing as a financial service sector, a job, another business, you're going to go into bankruptcy. That's a big, huge change in this bill. Secondly, consumer protection. We've never, ever, ever before had an agency, a bureau, or division specifically designed to guarantee that the consumer of financial products are going to be protected. That independent, autonomous agency is in this bill. And then, of course, the other provisions dealing with derivatives, these exotic instruments that where there's been little or no transparency or accountability. We reformed the banking structure so you have clarity which of these regulators is in charge of which section of our financial services sector. Anyway, there's a lot in this bill, but those are the four major points.
Senator, let me just back you up a little bit. You talked about the Consumer Protection Agency. You called it independent and autonomous.
You bet.
Now, that's what the House passed in its legislation, but your legislation would put that watchdog agency inside the auspices of the Fed. And many people are saying, well, isn't that a little bit like the fox guarding the hen house? Because the Fed, one of the things it has to do is protect the banking system. So can that watchdog agency really have any teeth? Can it really represent consumers?
Absolutely. Where it's standalone and independence are distinct words here. The proposal by my Republican friends was that they would like to, there's opposition to the idea of having a standalone. I would prefer to stand alone, but in this case here we're housing it in the Federal Reserve. But it has appointed, the director is appointed by the president, confirmed by the Senate, a completely independent, autonomous budget, autonomous rule writing. So where it's located, so much has been paid attention to that aspect of this rather than the independence of the bill. I urge people to read the bill. And if they read the bill, they'll come with a different conclusion.
I want to also get back to the exotic derivatives, the complex derivatives. Right. I mean, there's really no way to break it down in an easier way. But, you know, there have been warnings for years about the risk associated with these exotic derivatives. You sat basically at the head of the most powerful banking committee for years while all this was happening. Does Congress have a role in what happened? And why should we trust that now Congress will be able to get it right?
Well, Kieran, I became chairman of the committee about 36 months ago, not years ago, frankly. And when we started holding hearings on this in January and February of 2007, these matters had already been going on for years. So I don't disagree that there should have been far more oversight, far more accountability. But my job as chairman began only that many months ago. And frankly,
3
these
years
items
ago.
have gone...
3 years ago, you're saying.
That's right, exactly. January 2007. The fact of the matter is there's been little or no transparency, accountability. This bill has very strong provisions. Derivatives and these ideas aren't bad necessarily. It's the idea that you have clarity, you have transparency, accountability, registration, regulation of them, so that we know what's going on, and you don't end up with the kind of problems we've seen. They become bad words, but if they're well run, properly regulated, they can actually be a very positive point in our financial system.
Senator, we had one question that was given to us by a viewer that we wanted to pass along to you today. It comes via Twitter. Ed Riding asks, quote, does Senator Dodd feel any responsibility for his role in the housing collapse that started our economic catastrophe today? You're the chairman of the Banking, Housing and Urban Affairs Committee. What do you have to say to Ed there this morning, Senator?
Well, not at all. In fact, one of the very first hearings we held more than 3 years ago, when I became chairman of the committee, was the foreclosure crisis. For all of 2007, we could not get the attention of the Bush administration on this issue or the Federal Reserve. And frankly, that was the major cause of this problem, the securitization of mortgages. We had passed in 1994, the Congress did, something called the HOPA legislation, which required the Federal Reserve to actually promulgate regulations dealing with fraudulent and deceptive practices in the real estate area. They never promulgated a single regulation. And as a result, you had mortgages that people didn't understand and can't afford that were then being securitized. And that was the underlying cause of this problem. And frankly, that's a major area that we try to clean up in this bill here, again, through that Consumer Protection Agency, to see to it that consumers, whether it's mortgages, credit cards, payday lenders, will get protections they've never had before.
All right. Well, we hope that Ed's listening this morning, and maybe he can tweet us back and tell us what he thought of your answer. Senator, great to see you this morning. Thanks for joining us.
Not at all. Thank you, John. Thank you, Karen.